Hi, my name's Libby Newman and I'm an investment strategist here at Vanguard. Welcome to the Markets and Economic Update. Investors have faced a wild ride in 2025 and the excitement, for better or worse, may not be over. Equity and fixed income markets took less than a month to recover after US tariff announcements in April, giving investors a valuable opportunity to re-examine their relationship with risk. Even though we've been on a round trip back to where we started the year, not everything is back to normal. So what hasn't changed and what has? What hasn't changed is the market's pricing of risk assets. The US equity market is priced historically high relative to company earnings. What has changed? US bond yields are higher, the yield curve is steeper, meaning investors are demanding higher returns to hold longer dated bonds, and the US dollar is weaker. And this is likely for legitimate reasons. With the fog around tariff policy making slowly receding, attention is shifting toward the sustainability of US deficits. On May 16, Moody's became the last of the three major credit rating agencies to strip the US of its top rating. Markets took notice, sending the yields on a 30-year Treasury bond briefly above the psychologically important 5% level. Increased scrutiny of fiscal sustainability, along with tariffs' impact on the economy and ultimate landing point, will likely remain a focus in the months ahead. Here in Australia, the direct impact of US tariffs is limited. We export relatively little to the US and our goods face the lowest reciprocal tariff rate, just 10%. But the indirect effects, they're more significant. Slower growth in China and the shaken business and consumer confidence are likely to weigh on our domestic economy. Inflation should remain within the RBA's 2 to 3% target band, but likely towards the upper end of that target. A tight labour market is keeping wage pressures elevated and weak productivity growth is slowing the disinflation process. The RBA, as expected, cut the cash rate on May 20 by 25 basis points to 3.85, and we expect 2 more rate cuts this year. So what does all this mean for your portfolio? Volatility is a reminder to stay diversified. Defensive sectors and quality bonds can help cushion those shocks. The global shift in focus from trade tensions to fiscal sustainability will likely shape market sentiment in the months ahead. Stay optimistic, but be prepared for those downturns has been the lesson so far of 2025. Thanks for watching and click on the link to read on.